I need to record. I think it's recording now. Once again, welcome to Learn the Markets Mastermind Day 1, Introductions to Trading and Options. You guys can unmute yourselves at any time to ask a question. I will ask you guys at the end of each slide if you guys understand. All right. So first, let's go over some basic stock terminology. All right, guys. You guys can get this in the Discord under the vocabulary section. We'll go over the basic stuff so very quickly, just so you understand some of the words I'm saying if you know none of them at all. So stock ownership. Stock is a unit of ownership in a company. It represents a proportional share in its assets and earnings. Think of owning stock in a company as owning a piece of a pie. The more you own, the bigger the pie you own. Ticker symbol, such as AAPL, TSLA, those are for Apple and Tesla. It's a unique combination of letters representing a specific stock. We don't need to get into any of this yet. I'm just getting you guys in the basics of the words that we're going over today. The hell is that? I muted you, buddy, because I don't know what the hell that was. All right, options terminology, because we're going to get into some options today. You have two types of options. You have a call option and you have a put option. Call options, generally, you want the stock to go up. Put options, you want the stock to go down. It's as simple as that. You have the strike price, the premium, and the expiration date. Those are the three main things of an option contract. So the strike price is the predetermined price at which the buyer of an option can exercise their right to buy or sell the underlying asset, which we'll get into. The premium is the price paid to the option for the options contract to the person who wrote the options contract. It represents the intrinsic and time value. The expiration date is the date on which an options contract expires and becomes invalid for exercise or trading, and it's pretty much deemed worthless. So now that you guys are familiarized with those very basic words, we'll get right into it. Our agenda for today, we're going to get you introduced into trading, stocks versus options, the basics of options, call and put options, options terminology, some practice exercises, and then a short Q&A at the end. So think of trading like a marketplace. Instead of buying and selling normal goods like fruits, clothes, or electronics, we're dealing with financial instruments like stocks, bonds, and options. So imagine if you're at a market and you see apples are selling for $1. Now you buy a bunch of them. The price of apples now go up to $1.50. You decide to sell those apples for $1.50 each. You make a 50-cent profit on each apple you sell. That's what trading is. You're buying low and selling high. But instead of apples, we're buying and selling financial instruments like stocks and options. Stocks. So stocks represent an ownership in a company and constitute a claim on part of the company's assets and earnings. When you buy a stock, you're buying a piece of that company. Like I said, think of it as a piece of a pie. Let me close my window really quickly. This makes you a shareholder. So if you own a piece of the pie, you're a shareholder in that company, right? As a shareholder, you have the right to share in the company's profits, which may be distributed as dividends, which we'll get into. And you also have the right to vote on certain company decisions. For an example, if Apple issues 1,000 shares in the market and you buy 100 shares, you would own 10% of Apple. So think of stocks like buying a house. When you buy a house, you own it. You can live in it, rent it out, sell it when the price goes up. Buying a stock is similar. When you buy stock, you're buying a piece of a company. If the company does well, the price of the stock goes up, and you could sell it for a profit, and you can reap the rewards of dividend-paying companies. Now, how is a stock price determined? So it's simple: supply and demand. If more people want to buy stock, which is the demand, than sell it, which is the supply, then the price will go up. Conversely, if more people wanted to sell the stock than buy it, there would be greater supply than demand, and the price would fall. Unlike stocks, options do not represent ownership in a company. Instead, options are contracts to give you the right to buy or sell a stock at a certain price before a certain date. The key word here is right. You're not obligated to buy or sell a stock. You have the option to do so if you choose. Most option traders solely trade premiums. They don't exercise those contracts, which is the buying or selling of the stock. We'll get into that. How are options used? Options are used in a variety of ways. Some people use options to hedge against a possible decrease in the value of a stock they own. For example, if I owned Apple stock and I thought their earnings were going to be bad, I would buy puts to cover the losses of the equity of my shares that would take. So let's say Apple shares lost $10 per share. I buy puts So then I protect my shares from going down and I buy more shares at a lower price with the profits that I made off of those puts. Others use options to speculate on the direction of stock prices, hoping to profit from correctly predicting the future price movements. Same example. If I thought Apple's earnings were going to be good, I would buy calls speculating that the price of the stock would go up because their earnings were great. And some use options to generate recurring income. For example, if I own Apple shares, if I own more than 100 Apple shares, because you got to remember, every single options contract has a value of 100 shares. As an option contract writer, I would have to own at least 100 shares. So if I wrote an option contract, I'm selling it to you, the option buyer. You're paying me the premium. But if you don't exercise that contract, I still own those shares and I collect that premium. So that's how you can make some recurring income by owning shares on a company and writing options. Now, an example for options, we're using the same house analogy. If you're interested in a house, but you're not sure you want to buy it yet, you make a deal with the owner. You pay them a small amount now, and they give you the option to buy the house at a certain price within the next 3 months. So let me give you this example. He's selling the house for $100,000, or he's selling you a contract for $10,000. If you guys want to write this down and make it much simpler for you guys, got to remember, $10,000 is the contract, but it has an expiration date for 3 months. You either have to exercise that contract, which is buying the house for $100,000, or sell your contract to someone else for a higher or lower price, depending on whether or not the price of the house went up. So let's say the price of the house went up to $150,000. Well, the value of the house. You purchased your contract for $10,000. Your contract is now worth $15,000. You can sell your contract for a $5,000 gain, or you can exercise that contract and you'd have to purchase that house for the strike price of $100,000. See how what I did there? The strike price is the value of the house in the beginning, right? Of the contract. It was a $100,000 house. So your strike price is $100,000. So if you were to exercise that contract, you would be paying $100,000 for that house, even though the value of that house is now $150,000. So if you exercise that house or that contract, you paid $100,000 for the house that's now worth $150,000. So you can sell the house now for a $50,000 gain, or you can go in with a lot less and solely trade the premium of the contract, which was that $5,000 gain. So you paid $10,000 for the contract that's now worth $15,000, and you sell the contract to someone else that may exercise it and buy that house for the same contract, but they have the full $100,000 to actually purchase the house. So let's say you don't have the $100,000, you only have the $10,000. So you're only able to buy that contract. That's where the leverage comes in with options and stocks. Think of it this way. You can't purchase $100,000 of stock. So you purchase $10,000 worth of options. Your $10,000 worth of options went up to $15,000. You gained $5,000 in premium on those contracts. Versus if you paid $100,000 for that house, you gained $50,000 in equity on the shares of that house. Think of the house as a company. Does that make sense? You guys can type in the chat if that makes sense. If not, I could re-explain. All right, perfect. The main difference between stocks and options is that stocks give you a small piece of ownership in the company, while option contracts give you the right to buy or sell the stock at a specific price by a specific date. The specific price is the strike price. The specific date is the expiration date. Remember that. With options, you're not purchasing ownership. You're purchasing a potential future transaction. And most of the time, people are just solely trading the premiums, and they're not ever exercising the contracts. Sorry, let me get this out of the way. Sorry, wait, yeah, okay. Stock characteristics. So we'll get into what stocks are essentially. So most of the stock that people are buying is called common stock. Most normal investors aren't buying what is oppositely known as preferred stock. So we're just going to talk about common stock for today. Common stock is an investment security which represents ownership in a company. So if someone you know says that they own stocks such as Apple, Tesla, or Microsoft, they're referring to common stock. So if your friend or relative owns any few shares of a company, they are therefore a shareholder of that company. Think of stock shares as a piece of a pie. Remember that. By buying a share, you own a tiny piece of the pie. The more shares you buy, the bigger pieces of that pie you own. For example, Microsoft stocks are worth $200. You decide to buy one share. The stock then increases from $200 to $210. The equity on your shares gained $10. The only way you actually profit on the $10 that gained on that share price is if you sell. So remember that. Just because the stock price went up doesn't mean you made any money. It's just the equity in the shares went up. So if you bought 2 shares, it's 400 in total. You would have made $20. Simple, right? So another name for stocks, also known as equity or equities. Remember that. What are dividends? So remember we talked about dividends earlier. Some companies provide dividends. Dividends are payments made by the business company to its shareholders, also known as you, if you own shares in that company. Some payouts can be given to you in cash dividends, which they'll pay you out in a few cents or whatever it is per quarter, or sometimes they'll give you shares. Not all companies give out dividends, so you have to look for the ones that do, and especially look for the good ones. They provide a great valid flow of income. It's good for long-term portfolios. You want to get that for your Roth IRAs. You want to have some dividend-paying companies. It's great for your portfolio. For example, a company that pays dividends trades at $44 a share. The company pays a dividend of $1.50 per share annually, broken up into quarterly installments of 30 cents. Now let's get into what that means. Every quarter is 3 months. There's 4 quarters in a year. So when you hear about quarters, it's every 3 months. All right. So if you own a stock share and you can expect to receive a cash payment of 30 cents every 3 quarters for each share that you own. So if you owned 100 shares, you would get $30 from dividends every 3 months. So think of it as like interest gained, right? You bank accounts, they give you % interest, right? Well, this is kind of like that, but it's not the same at all. It's just think of it in a similar aspect. You make money just by holding it. So how can you make money with options? One way is through income generation. Remember we talked about income generation. If you own shares of the stock, you can sell, well, it's also called as writing the options contract. Another name is you can just sell them. So not another name, but the normal way to say it is you're writing the contract. But simpler ways, you can sell call options on those shares to generate income from the options premiums. This is known as a covered call strategy, which we'll get into like day 4. You can also sell put options on a stock that you believe is overvalued, collecting the option premiums as income. Remember, you can only do so if you own those shares, and each contract is 100 shares. So for every contract you write, you must own 100 shares. So if you wanted to write 5 contracts, you must own 500 shares. You're putting those shares up I don't want to that'll get too complicated. We'll talk about that another day. Options can also be used for protection. If you're concerned about the potential for a decline in the value of a stock, you can buy put options as a form of protection. Remember I said that earlier. If I owned Apple and I was scared that the earnings would be bad, I'd buy puts so that I could profit off of that decline in stock price and then use that profits to purchase more shares. So this allows you to sell the stock at a predetermined price if the value decreases, potentially resulting in a profit. Finally, options can be used for speculation. Remember, if you think something's going to happen, you're speculating. If you believe that a stock is likely to increase in value, you would buy call options as a speculative play. If the stock price increases as expected, you would sell the options for a profit and premium. The same way, if you thought a stock would decrease in value, you would buy put options. If the stock did go down, you would make money on the put options premiums. Does that make sense? Would any of you need me to go over that again? Or are we good? I hope we're good. All right. So what are the advantages of using options over stocks? One of the main benefits of options is the ability to leverage your investment. Remember, I'll use the house example again. If you don't have the $100,000 for the house, but you have $10,000 and you believe that the house's value is going to go up, I'm leveraging that $10,000 for something that's worth $100,000 right now, right? So one of the main benefits is leverage. Because options have such a lower upfront cost in stocks, you can potentially achieve a higher return on investment with a smaller initial investment. Options also offer more flexibility than stocks, as you can choose from a variety of expiration dates and strike prices to suit your investment goals. Options can also be a useful risk management tool. For example, if you own shares of a stock and are concerned about the potential for a decline in value, like I said before, you can buy put options as a form of protection. This allows you to sell the stock at a predetermined price if the value decreases, potentially resulting in a profit. However, it is important to keep in mind that options also come with their own set of risks. Very risky. So you guys don't think this is very easy. It's not easy at all. Sometimes it's a lot more riskier than just purchasing stocks in general, but high risk, high reward. And that's where it comes in. So options have expiration dates. Remember, I told you that. If you don't sell your contract before that expiration date, your contract becomes worthless, which means you lose all the money you put into that contract. Remember that. It's very important. Shit. Yeah. Options characteristics. All right. Familiarize yourselves with these terms. Remember, I was telling you guys expiration date, right? All options have an expiration date. They no longer exist or can be traded once they expire. Shares of stock, they don't have expirations. You can hold them forever, essentially, or until they get delisted. All options have what's called a strike price. So remember I told you the strike price with the house analogy. The strike price was $100,000 on that. That means you would purchase that house for $100,000 if you exercised your contract. So an option can be converted, also known as exercised, into shares of stock at the option strike price. So for example, if my call option has a strike price of $100, I can exercise my option contract and purchase those 100 shares, because you guys remember, every option contract gives you the right to purchase 100 shares at $100 per share, which was the strike price. Does that make sense? Let me know in the chat if it doesn't. Here we keep going. Pay attention here, because this is where some people get confused. They don't understand why options are priced the way they are. We're going to get into how options are priced tomorrow, or not tomorrow, in day 2, which would be actually might be tomorrow. I don't know. Tomorrow, Monday. But it's very, very simple. If you ever look at an options chart, like not option chart, sorry. I'm blanking right now. If you ever look at an options chain and you see that the prices look like they're in dollars and not by the hundreds of dollars, and you're confused as to why when you try to purchase that option, it's charging you 10 times what it's supposed to be. Well, think of it like this. A share of stock with a price of 100 can be purchased with $100, but the price of the option contract is 1.50. You can't buy the option contract for $1.50. It's $150. You got to remember, you're trading 100 shares. You're leveraging 100 shares. So if your options price is 150, you got to times it by 100, which is $150. So the same way, if your options price at $5, it's $500. Does that make sense? Yeah, total. Thank you, Bubba. I don't know why I was blanking that. So it's very, very simple. If you ever look at an option chain, you'll see that they're in dollars, but it's not in dollars. Just move that period over to the left and you're good. And the same aspect when you'll see it say like $10, right? 10.00, that's $1,000. Okay. Does that make sense, guys? It's very, very simple, but some people get very, very confused by it. It's very simple though. All right, basics of options. Like I said, options are contracts that give you the right to buy or sell an underlying asset, 100 shares to be exact per contract, like a stock at a certain price before a certain date. Remember, the strike price before expiration. But how do you make money with options? Like I told you before, if you believe that the price of a stock will go up, you would buy calls. If you believe the stock price will go down, you would buy puts. It's as simple as that. I'm not going to read this entire thing. You guys can read that yourselves. It's very, very simple. Calls up, puts down. Just remember that. Here's a visual representation. So long calls, they make money as a stock price goes up. Let me see if I could draw in here. Shit, sorry. All right. As you can see, as the stock price goes up, you see 40, 50, your profit goes up. But as the stock price goes down, not only does your profit go down, but then your contract becomes worthless at some point. The same way for puts, as well, the opposite. As the stock price goes down, see it's going down, your profit goes up. But if the stock price goes up, your profit goes down and your contract ends up becoming worthless, because on puts, you make money as the stock price goes down. On calls, you make money as the stock price goes up. It's very, very simple. Once you guys get that down packed, like you won't forget it. Calls up, puts down. So when you buy a call option, you're betting that the price of the underlying asset will rise above the strike price before the expiration date. If this happens, the call option increases in value. So here's an example. So suppose you buy a call option for company XYZ with a strike price of $50, expiring in 1 month, and you pay a premium of, what the fuck just happened? Sorry. Shit. Excuse my language. And you pay a premium. Let me restart. Sorry. Suppose you buy a call option for company XYZ with a strike price of $50, expiring in 1 month, and you pay a premium of $2 per share, or $200 for the contract. By the way, once again, that would look like 2.00 on the options chain, $200 for the contract. If within that month, the price of the company rises to 60, your call option will increase in value. Why? Because you bought a call option. You could then sell the option for a higher premium because your options gain premium as the price goes up on a call option. Your price of your contract's premium goes up on a put contract as the stock price goes down. Remember that. Calls up, puts down. So now if your premium is $10 per share, which would look like 10.00 on the contract, you could sell the option for $1,000, making a profit of $800. It's very simple. And the same exact way for put option. So if you buy a put option for the company XYZ with a strike price of 50, and you pay a premium $2 per share, which would be a 2.00, which is $200 on the options chain. Within that month, the price of company stock falls to 40, your put option will increase in value. Why? Because the stock price fell. Very simple. Now, remember, you're not obligated to buy the shares, which is exercising the contract, which is the same way you're not obligated to buying that house for $100,000. You can just sell the contract. You're profiting purely from the increase in the options premium, buying the contract for X price and selling the contract for a higher price before the contract expires. So like in this aspect, you bought that contract for $2. You sold that contract for $10. So remember, $2 and $10 is 200 and 1,000. It's very simple. So some options terminology part one. You guys are going to need to either write these down or memorize them, however you want to do it. But these are very important terms. I know I went over them already, but you have to remember them. So the option, it gives the buyer the right, but not the obligation to buy or sell the underlying asset at a specific price on or before a certain date. Now, what is that underlying asset specific price called? The strike price. Remember that. The strike price is where you would be able to if you exercise the contract, you'd be able to purchase those shares, 100 shares at that price. So if your strike price was $10, you wanted to exercise that contract, you would be paying $10 for every share. So 10 times 100, that's how much you would pay for those shares. Where does that make sense? That makes sense if you bought a call contract for $10, the $10 strike price, right? And the stock went to $50, but this company is doing amazing. You like it long-term. You see the long-term vision in it. You might want to exercise that contract if you had the funds in order to pay for those 100. Got to remember, you have to have every dollar for those 100 shares that you're purchasing. But it makes sense for you to purchase those 100 shares for the long term because you're buying them at a $10 strike price. So your average now for that stock will be $10, and it's now valued at $50 per share. Does that make sense? Your strike price is what you're purchasing those shares at if you exercise. Exercise means you purchase the 100 shares once again. So call option, I told you guys, call option up, put option down. It's very simple. Expiration date is where your contract becomes void. An example of an option contract will look like this. It'll say $100, which is the strike price, $100, 5/25, which is May 25th, which would be $100 strike price, and then let's say put, right? $100 May 25th put. That means by May 25th, you want the price of that stock to be below or at $100. Does that make sense? Because if not, if the stock price is not below that price by the expiration date, your contract will essentially be deemed worthless if you hadn't sold it already. So you got to remember, the expiration date is very important. When it comes to buying options contracts, you generally want to buy expiration dates that are further out. So let's say I'm seeing a move in the market that can occur within the next 2 weeks. I would purchase an option contract maybe 1 month out. Give me extra time on that contract, because let's say in those 2 weeks that move didn't happen, I want to still be able to have value in my contract and not have it be deemed worthless. Because if the move didn't happen in my favor during those 2 weeks, I still have 2 weeks on that contract. Does that make sense? Versus having zero time and now my contract's being deemed worthless because it didn't meet my strike price or go below my strike price on the put option. Does that make sense? Yeah, I don't see any questions, so I guess so. Premium. Exactly. Giving yourself a time cushion. Exactly that. Exactly that. So the premium is the price that the buyer of an option pays to the seller. So I'll give you another example. Let's say you saw an option contract at 1.50, which would be $150. But the value of those shares really is probably worth 110, like 1.10. The premium you're paying is 0.40. So you're paying that person who wrote the contract $40 in premium, right? So already you're down, right? Because even if you exercise the contract, you're not getting in return what you paid for that contract because you're paying a premium. But that's the reason you're buying that contract, is because you want to make money on the contract. You want that price to go further than your strike price. Your strike price, remember, is what you bought the $100 May 25th. The $100 is the strike price. That's where you want, and if it's a put, you want the price to be below $100. You would make more money on top of that. And then when you sell it, you're selling it for a premium as well. Why? Because you bought it for $140 and you're selling it to $240 to someone else. They just paid you an $100 premium. Does that make sense? So in options, everyone's paying each other premiums. When you're buying and selling contracts, it's just a trading of premiums unless you exercise that contract. Like I said, most option traders, we trade premiums. We trade the fluctuation of premiums in contracts. Now, here's some terms that I want you guys to familiar yourselves with now for day 2, because we're going to be talking a lot about this stuff. In the money. An option is in the money if exercising it will result in a profitable trade. So for call options, this means that the underlying assets price is above the strike price. For put options, it means the underlying assets is below the strike price. I want you guys to take out a piece of paper so you guys can actually visualize this. All right. So let's say your strike price is $50, right? If your contract was in the money on a call option, remember, you want the price to be going up. So if you were in the money, your contract would be below $50. Does that make sense? So you would have a $49 call, $48 call, $47 call. Those are considered in the money because the price of the asset is at $50 right now. It's above. Does that make sense? Because your strike price is $49. The price of the asset is $50. So you're in the money. Your contract is in the money. Now, when you're at the money, that means your contract is at the same price of the asset. So if our asset price is $50 and you have a $50 call, your contract is at the money. It's the same. Right? Now, if it's out of the money, your contract will be above that 50. So let's say you have a $55 call. That means you want the price to go from 50 to 55. You're out of the money though. Your contract is $5 out of the money. Does that make sense? In the money, at the money, out the money. In the money is if your contract is making money. It's below the strike price on the call options, and it's the opposite for puts. So for puts, I'll give you guys a put example as well. Visualize this. Put the number 50 on a paper. Now for puts, you're in the money if you have a 51 or above. Why? Because that means the price is already below your strike price. Your strike price is $51, right? You have a $51 put. Now the asset price is 50. You're in the money because the price of the asset is below where you got your strike price at. Now, if your contract was at the money on a put contract, it's the same thing. $50, $50. It's at the money. At the money, just think of it as equal. Out of the money, that means my contract is at $45. I have a $45 put, but the asset price is at 50. So I need the price to fall so I can get closer to at the money. Got that? If I'm out of the money, I need the price to come down to come to at the money. And then I need to come even more down to get in the money. Does that make sense? In the money, at the money, out the money. Open interest is the total number of outstanding options contracts in the market. On an options chain, you'll see OI. It's also known as OI, but it's open interest. That's showing you how much liquidity is within that contract. It's a specific contract because every contract has its own open interest and every contract has its own volume. So volume in the options market refers to the number of contracts traded in a day. Volume is very simple. Open interest is very simple as well. Exercise. You guys gotta remember, exercising is if you want to purchase those shares. So if you have that contract, you have the right to purchase the 100 shares. You don't have to, but you have the right. And that's called exercising. The same way, let's bring it back to the house analogy. The house is worth, the house strike price was $100,000. It's worth $150,000 now. I'm going to exercise my contract, but I have to pay that full $100,000. Got it? Exercising is when you actually purchase the shares of that contract. You're not trading the premiums at that point. You're fully buying those shares at that strike price. All right. Now, I need you guys to actually be engaged here and answer in the chat. Consider you're bullish on a company called TechRise, which is currently trading at $100. You believe that the price will rise in the next few months. As an options trader, what kind of option would you consider buying to potentially profit from your market outlook? Tell me in the chat. Good shit. There we go. Yes, sir. Yes, sir. Yes, sir. You guys got the jump now. All right. Now imagine you have shares in a company called Health Grow. It's currently trading at 200. You're concerned that the price may drop significantly over the next few months due to an upcoming controversial regulatory decision. As an options trader, what kind of option could you buy to potentially protect your investment from a significant drop in price? Yes, sir. Yes, indeed. Yes, indeed. So you guys are getting it. Now, you're looking at the options for a company called Green Energy. You notice that the call options are very expensive compared to the put options. What might this tell you about market sentiment towards green energy? Remember how I told you guys just how the value of that contract wasn't the value of the shares and had an extra premium on it? Why is there that extra premium? Why might that be? What is that telling you about the market sentiment? If the call options are more expensive, they're adding a higher premium on it, making you pay more for them. No. I'll explain this soon once you guys. Think of it this way. Remember I told you, someone was trying to charge me 140 for a contract that's really worth 1.10. I'm 1.10. They're charging me a $30 extra premium on that contract. Why? Because they know that people want to buy the contract. Because let's say it's on Apple, right? Apple had great earnings. People are charging an extra premium on the contract because they know people want to buy calls. So if call options are very expensive, more like valued at higher than they should be, it's because the market sentiment is bullish. People are buying calls fast like that. So the contract writers, the underwriters, are taking advantage of individuals being bullish on that stock because they're selling the call options for higher premiums. Does that make sense? So let's say on a day where you saw puts look very cheap, but like puts look super cheap compared to calls, and calls for some reason you're like, why are the premiums so high on them today? And you go and look at the chart and there's a lot of demand that day and we're breaking past levels to the upside. That's the reason why the call premiums are so high, is because today is a call day. Today is a day where the stock is going up, where people are buying more calls than puts. So the call options are valued higher. So if the call options are more expensive compared to the put options, the market sentiment would be that people are bullish on that day, or people are bullish on that stock because they're buying calls, and they're buying calls for higher premiums as well. Does that make sense? You guys understood that? And it's the same way for the other way. It's not more bullish on a stock, the premiums will be higher. It's either or. So even if it was bearish on that day, the premiums will be higher on the puts because more people are buying puts that day. It is a bearish day. The stock is going down and puts are making money. So the people who are selling the puts are selling them for higher prices because they know people will buy them, because people want to buy them, because they want to make money on the decline of that stock. So this is just about market sentiment here. So if you're looking at the options chain, you're looking at the options prices. By the way, the next class we're getting some more into options pricing, but this is just about market sentiment here. The options contracts premiums are higher on the call side, and you go and look at the chart and the stock is going up that day. That's how they correlate there. Does that make sense? It's very simple. No problem. The next one. Okay, this is where you guys, I want to see if you guys get this concept. Consider buying a call option for a company called Auto Future. It's currently at $50. The current assets value is $50. There's 3 options available: a call option with a strike price of 45, a call option with a strike price of 50, and a call option with a strike price of 55. Which option is in the money? Which one is at the money? And which one is out of the money? Indeed. 50 is at the money. Exactly. Yes. All right. So you guys understand that concept. Great. So that's in the money, at the money, out of the money. So the 45 is in the money because it is below the current assets price, and a call option is remember, is to go up. So if your strike price is below the current assets price, that means the assets price is above your strike price. You're in the money. Now, if your strike price was 50, which is the current assets value, you're at the money. And if you're at 55, you need the stock to keep going up because you're out of the money. Perfect. You guys understand it. All right. So recap and Q&A. So today we pretty much went over the basics of options trading. We understood the basics of stocks as well, and how options trading differs from normal stock investing. We learned that trading involves more frequent transaction, is more driven short-term price fluctuations, the trading of premiums, while investing is a long-term activity aimed at accumulating wealth over time, such as companies that you own that earn dividends. So we explored the two types of options, call and put options. Call option gives the holder the right to buy a stock at a certain price, and you buy call options when you want the stock to go up, while put options gives you the holder the right to sell a stock at a certain price, strike price, once again. I just want to embed that in your brains. And you buy put options when you want the stock to go down. And you learn that traders buy call options when I just said that, sorry. We also discussed the key components of an option contract: the premium, the strike price, and expiration date. The premium, the price paid for the option. The strike price is the price at which the stock can be bought or sold. And the expiration date is the last day the option can be exercised. And then I also introduced you guys some essential options terminology: the in the money, at the money, out of the money, and how these terms relate to the relationship between the stock's current price and the option strike price. Any questions? Give me all your questions now, please. You guys can turn on your mic if you want, doesn't matter. But please give me your questions, because that is the end of day one, and I'll get into day two's thing right after the questions. Sin preguntas. Yeah, I'll post this on the Discord. This is the basics. You gotta remember, this is the basics, because once we start diving into day 2 and day 3 and day 4, if you didn't know any of this stuff, you would be super confused. Like, if you don't know the basics of what a call option is, the basic of what a put option is, when you buy a call option, when you buy a put option, if you don't know what the in the money, at the money, and out of the money is, you'll be very confused on the next lesson. So you guys understand what the difference between buying stocks is, when the difference is buying options is, correct? And what the difference is buying a put and buying a call.
Don't be looking at my phone.
What?
I'll tickle you to death.
What the fuck? Yeah. So any questions at all, or was everything pretty good? You understood? Everyone understood everything? Great. All right. So day 2. So for day 2, we're going to dive deeper into the world of options trading. We'll explore the intricacies of options pricing and introduce you to the Greeks: delta, gamma, theta, vega, and rho. These are crucial tools that traders use to assess the risk and potential reward of an options position. If you don't understand these, you can't trade options. We will break down the concepts of intrinsic value and time value, which are key components of an options price and how they move. Understanding these concepts will help you make more informed trading decisions and understand how to trade options entirely. The Greeks will help you understand how different factors, such as changes in the underlying stock's price, time decay, and the changes in IV, also known as implied volatility, can affect the price of an option. By the end of day 2, you'll have a solid understanding of how options are priced and how to use the Greeks to assess and manage your risk in options trading. So if you guys are interested in day 2, make sure to message me to sign up, because day 2 is not going to be free. But that is all, guys. If you have any questions at all, there's a chat room in the Discord. Make sure to ask any questions. I'm going to post the video once it's done downloading, and that's it. And for all of you who did not make it and you watch this video, you have any questions, same thing, message me if you have any questions. But I'm not going to lie to you guys, this basic stuff is pretty self-explanatory. It's very easy to understand. Once you understand it, it's down packed. You just move on to the next thing, which is options pricing. And that is not simple. Today was simple for calls and puts, but the next lesson is not simple at all. So you guys need to come prepared, come ready to learn, come with a notepad, pen and paper. It was nice talking to you guys. Enjoy your night. If you have any questions, once again, Message in the chat room. Peace.